There will be a lot of focus on Friday's U.S. jobs report, which is shaping up to be the next major test for financial markets after another impressive run higher in risk assets this week. Consensus is looking for payroll growth to remain modest, somewhere in the area of 70 to 90,000 jobs, while the unemployment rate is expected to hold steady at 4.2%. Following June's surprisingly soft payrolls report, investors will also be paying close attention to any revisions, particularly after several private labor market indicators have painted a somewhat healthier picture of employment than the official government data suggested. The report arrives at an important moment for the Federal Reserve. While recent geopolitical de escalation has helped ease energy price concerns, inflation remains above target, meaning policymakers continue to balance evidence of gradually cooling labor market against the risk that underlying price pressures remain too persistent. That makes this release about far more than just the headline payroll number. In particular, average hourly earnings could prove just as important as payroll growth itself. Wage growth remains one of the clearest gauges of domestic inflation pressures, and a combination of softer hiring alongside firmer than expected wage gains would complicate the Fed's outlook by suggesting labor demand is cooling without enough relief on inflation. Conversely, a moderation in wage growth would reinforce the view that inflation pressures continue to ease alongside a labor market that remains orderly. From a market perspective, what investors are likely hoping for is another Goldilocks report: payroll growth that is neither too hot nor too cold, unemployment holding broadly steady, and wage growth showing no signs of reaccelerating. That combination would reinforce the soft landing narrative that has underpinned the recent rally in equities, while also allowing treasury yields and the US dollar to remain relatively contained. A materially stronger report, particularly if accompanied by firmer wage growth, would likely push Treasury yields and the US dollar higher as markets scale back expectations for future Fed easing, while weighing on interest rate sensitive areas of the equity market, especially technology and other high growth sectors. On the other hand, a modest downside surprise in payrolls, provided wage growth also cools and unemployment remains broadly stable, would likely be viewed as supportive for risk assets, reinforcing expectations that inflation is moving in the right direction without raising fears of a more pronounced slowdown in the U.S. economy. That's all for now.